We're live again for another Wednesday. Same old, same old. Today we're going to talk about specifically what's going on in the stock market and what's going on in the real estate market and how it kind of trickles down. Sorry, my camera's all messed up here, but yeah. Okay, so today in the stock market, for people that are watching, it's weird that it says 0 people are watching, but I can see thumbs up, so it must be connected. Someone jump in the chat and let me know that it's connected. Sometimes YouTube lags out like this and says that no one's on the stream, but anyway, I can see a couple thumbs up, so I know that people are live. But okay, we're gonna talk about what's going on here. For one, rates are on the rise. The market is now pricing in more rate hikes. We're talking about potentially 200 basis point jump. So let me put that in perspective. 6 months ago, 8 months ago, I was able to get a 1.255, so basically 1.25% 5-year variable mortgage. Today, we're looking at 5-year fixed rates of 3.5% to 4%, into 4.5%. Potentially, we're going from 1.25%, but people are getting rates at 1.25%, 1.5% all day in Canada, to now 4.5%, which 4.5% is a 300% increase in your interest expense on that line of credit, on that mortgage. That has real impacts. On top of that, if you've been following today, there's legislation coming in federally that will stop the buying of foreigners buying Canadian residential property. So they're going to ban it for 2 years. So that's going to stop all foreign investment into Toronto and to many different areas. And that's probably going to, not probably, it will happen. The Liberal government has formed a coalition with the NDP government, with the far left socialists, to do whatever they want. So they have a full majority. Let's play in the fact that we have some inflation stuff going on. Rates are climbing. It's happening. We're going to see rates we haven't seen since the 90s. I've made videos 3 years ago where I thought it wasn't possible. I thought the government couldn't afford to sustain the global impacts that will be related to the trying to service all of the debt that they have, because countries have debts to each other, right? There's actually national debt, and it's been growing and ballooning higher now than ever before, thanks mostly due to the pandemic, right, where there was a ton of money printing, and to print money out of nowhere you need to borrow, right, to cover, especially when you're not exporting like we were before. And we had some supply chain issues that have kind of led to what I would say is a bit of a recession, economically speaking. I know GDP has not been entirely reflective. And honestly, the CPI, the Consumer Price Index, hasn't been entirely reflective of what we're actually seeing as well. So while we try to rely on government data, a lot of it's cherry-picked, horrible, not representative of what people are actually spending. As an example, let's talk about rent being 45% of the average, or mortgage payment being 45% of the average person's spending budget. And yet in the CPI index, when mortgage houses have gone up 50% here in Ontario. So if houses are up 50%, mortgage payments on new houses are up. Rents are up 10, 15%, 20% in some pockets. Some of the downtown core where there's a shortage of good quality stuff, you can pay 25% more year on year. That's coming down now. We're seeing a relief in the pressure for prices of houses. There's a dip right now. Real estate in my city right now is down 3% on the month. Days on market growing, stale listings growing. That means opportunity. So is it a time to buy? Maybe. But I don't think all of the fear and the pain is priced in yet. In the stock market today, we watched the NASDAQ drop 2.5% in one day, as well as some pain yesterday. We're talking like 3, 4%, 5% dip in the last couple of days. That's painful, I would say, but it hasn't priced in all of the pain that is yet to come. There is turbulence ahead. I think that we will have more red days ahead. I'm mostly in cash in that portfolio. I'm moving towards the belief that, I don't know. So part of me is like, I'm still in the market. I still have, positive delta. And then I'm correlated to the market going up. I do better if the market goes up. But at the same time, and I don't want to miss out on the gains if the market rips again like it did in, what was that, like end of February? It just started to rip up. If everyone was following, we saw like 10% days, multiple days in a row. We saw, like the whole index moved like 8% in a week. It was insane. We came off some lows. Now we're seeing that kind of fall off. I thought it was a bull trap. I kind of thought people get sucked in and then get crushed again. So I don't know. Um, I'm bearish. I'm bearish. I'm still in the market. I've made some very poor decisions in January, and I stayed fully in the market with 1 times leverage, which is a mistake. And so and I had mostly tech in that portfolio. Overall, my portfolio year to date is up, but inside the tech portfolio that where I exposed myself to some options and some, naked puts on some growth and tech, that stuff got nailed pretty hard. And I'm holding names like Intel. I love Intel. They're under a 10 PE ratio, like a 9 PE ratio right now on Intel. I'm holding like Facebook. I love Facebook. They call it Meta now. Meta shares, because again, we're talking like a 13 PE roughly. It's almost on the verge of value. They're producing so much cash flow that they're almost a value stock, but then they're tech and they have the potential for a ton of growth. Some other names too that I have, like Sam. I think that, their cannabis drinks are going to be great. I think that, just in general, throughout recessions, when people are going through hard times, they drink. So, I think all of their division will do fairly well. Also, the stock's been pummeled from 1,300 a share to 390 a share. So that, it potentially has a 400% increase to go just to get back to where it was a year ago. So stocks like that have been beaten up quite a bit, and I still hold positions, probably larger than I should. I should be heavier cash, avoid margin. I think at times like this, debt is still your best friend. If you can lock in debt now at cheap rates before things get worse, especially variable debt right now is not so bad. I don't know. I'm of the belief that variable is always the better way to go, because if you want to sell the property anytime or you want to refinance the property anytime, you're flexible to do that without penalties. And the penalties are brutal. So as much as I think fixed rate debt is great, and I do have some fixed rate debt. Like I've got a rental I still have here in London that's on a 5-year fixed at 2.3%. So I don't feel any of the immediate increases as rates jump, potentially another 50 basis points on the next announcement, potentially another 50 basis points after that, who knows? We've already seen a little bit of a creep up. And so that sort of thing does trickle down into new purchases, but people who already have properties generally are not as affected. So I think that what we'll see and what we're already seeing right now is we haven't seen a huge pullback, but we're seeing a lot less demand, a lot less greed. And as interest rates rise, affordability decreases, right? Like if your mortgage payment was $3,000 a month before, and now it's $4,200 for the same house, you're like, well, I only make $100,000 a year, so I can only pay so much, and therefore your affordability would you'd be like, okay, I'm looking instead for a house that's $900,000 now, so I can get the payments down to the the 4,000 level or whatever your numbers are. People are going to play with their numbers a little bit more tightly than they were before. That's one thing that's pushing things down. At the same time, we've got all the speculators, which pretty much drive the local economy. And specifically, the speculators will potentially gob up a lot of this fear, a lot of this lack of affordability. They'll gobble that up and potentially could keep the market flat, or could keep it even slightly positive, potentially, while we have these all this negative news. But what I think is going to happen is, as soon as we have a full year where the market is not rising, people start to say, "Uh-oh, I better wait." There's no advantage to getting into this house now. I'll wait a few months. And when they wait, listings get stale, people get desperate, they start taking lowball offers, they start creating low comps, and it starts to drive the market down. And what'll happen is, with affordability dropping, we're talking about affordability changing 30 to 40%. That's huge. That could translate to potentially a 10 or 20% drop, especially. I see some questions here. I'll get to all your guys' questions here in a sec. I'm just going to finish my little rant, and then I'll go back into the rant. But I think that there's definitely a good probability of drop. Now, I sold most of my portfolio. I still have 7 properties, so I'm exposed to like $8 million in real estate. So a 10% drop hits me $800,000. Every 10% the real estate market drops, currently I'm exposed to about $800K of downside. So a 20% drop, a 1.6 million drop, just on the current little Canadian real estate portfolio that I have. Thankfully though, well, maybe not thankfully, last fall I sold everything with a January close, and sold a bunch of properties off, got into the stock market with a lot of those gains I took, and I wrote it down as the NASDAQ and the S&P 500 dropped 10%. I did that levered 2 to 1. So my 10% drop with the market, I dropped 20%. So that was just shitty timing. Like probably the worst possible timing to take money from real estate and put it into the stock market. But it is what it is, and you can't time the market. A year or two, 5 years from now, 10 years from now, I'll be way up, so I'm not overly concerned. But here I am, and I've locked in potentially close to the top. Like the market did jump another 10 to 15% here in London, Ontario, after I signed those firm agreements. I had certain properties that I sold. One of them I sold for 425 that relisted in the 500s a couple months later. So I lost out on like in some cases 20% appreciation in like 4 months. That to me was a red flag. Like that's when I wanted to, that's when I really wanted to get into closing all of those properties out. And so I've been working on that, and I've got got a sixplex listed now, which isn't a great location. If I wasn't planning to leave Canada, I'd probably keep that one. Solid building, great location, good rents and cash flow. But that one got listed up. We listed another one of our flips, got up there. We got another flip coming up, which I'm finishing up. I'm gonna get it listed. I got another rental property I want to get up, and then I have 3 more that are personal, which I could list. My mom lives in one. It's a triplex. I probably will sell that one too. Another one has a fixed rate mortgage, which would cost a lot to break out of, but I'll probably sell that one too at some point. I'm waiting to see what happens. I'm waiting to see how the market reacts. I think we may have a bounce back. I think that people have locked in good rates, and those rates are going to expire in the next 60 to 90 days, and they're going to have to renew at higher interest rates. They're going to be forced to buy something while they still have a good rate hold lock on. So my forecast, same as it was 6 months ago, is that we are going to have a downturn or at least a flat market in Canada where you're not going to have appreciation for 2 years, potentially. And I think that there'll be a little bit of a spike right now. And rightfully so. If you right now have a rate hold and it's good for 120 days, you're approved at a rate from January that you qualified in January. You need to be using that. Like there is mad value in having that low rate when interest rates double potentially over the next year. And so when we talk about 250 basis point increase, which is, I've heard some analysts call for 150. I've heard some call for 300. Some of the more extreme, analysts out there that are a little bit more bearish, I guess, on the market. They're calling for, extreme rates and interest hikes. And if you could lock in a low interest rate mortgage on a property, and you can get into something now, I think you'd be okay, especially if it's cash flow positive. That's what's important. You gotta be buying stuff that produces quality, good cash flow. You can hold. And in 5-10 years, I'm certain in 10 years, the real estate market will be a lot hotter than it is now, especially once Trudeau gets kicked out of government, and we have in 2025 new government in, and it'll probably be conservative. Everyone will be tired of the Liberals and NDPs. The Conservatives actually won the majority vote last election, but because the way our system is designed, if you lose by 1 vote in an area, all the votes for that party don't count. So the majority vote was still for Conservative, but based on the way that our system is designed here, the Liberals won a minority government. Then they created a coalition with the Socialist NDP, and now they have a majority Socialist government. And so, yeah, I think that'll all change in 2025. So 10 years from now, we're talking like 2032, I can see real estate in Canada being very strong. Canada has a great backdrop of strong natural resources, the most fresh water. It's the 2nd largest country in the world. Just for a number of reasons, and our immigration policies are such that like we will continue to have a shortage of available housing units. So there's a number of reasons why I think Canada real estate is strong long term. I wouldn't panic sell. I think probably not a great time to be flipping. There's just so much uncertainty right now. You have to do a really good job on the quality of product that you're selling, and just know that like where you might have got multiple offers that would drive you 100,000 over asking, now you might get multiple offers to take you $10,000 over asking, or might just get you asking. And so it's still a strong market. You could still flip and make money, and just be tight on your numbers, understand where you're coming from a cash flow perspective, making sure you have reserves set aside. Don't over lever yourself to the point where you can't sustain the debt service payments. So that's buying like land developments, any development type stuff that doesn't cash flow for years, speculating on condos and all that kind of stuff that you can buy in Toronto that people get into that has negative cash flow. That's the kind of stuff that's going to really suffer. We've seen prices in Oshawa, which is a market outside of Toronto, go from, I personally know some people in Oshawa and some agents there, where we were seeing comps on a street hitting like 1.3 million and now hitting 850,000. That's a huge drop in 3-4 months. So there are pockets already in Ontario right now that are down 20-30% from the frothy top. Now, they've really only taken us, like, even if we had a 10% drop in Ontario, we're talking about going back to a 20% drop is taking us back not even a year ago, 9 months ago. Like a 20% drop in our real estate market right now takes us back 9 months. Ooh, like big crash. 20% is a big crash, by the way. The government would step in at more than 20% drop. But that only takes us back 9 months. Just think about that. If you've been in this market for 2, 3, 4, 5 years, time in the market is the way to win in this game. And so I look at this as an opportunity to enter and to, if you're looking at the stock market, enter in real estate. But if you're looking at the stock market, I think there's opportunities on the really red days to write contracts, to slowly average in and get into the market. Could we go lower? Yeah. Might we go lower? Probably. But you can't predict the bottom, right? And I think that if you solely dollar cost average in on those really bad days, you'll thank yourself in 5 years that you got in, right? Like if you didn't get in at the bottom of 2008, but you got in like in 2009 when it was up like 15%, you're still way ahead by 2012, 2013. And today you'd be looking back being like, wow, I'm so glad that I bought then, right? So buy quality names, quality companies, quality properties. I think any property below $300,000 is a huge buy right now. There's not very many of those properties left in Ontario and in most markets, around North America. But those types of properties will do really well. They're working towards this great reset thing where like the middle class can't afford to own homes anymore. Those types of properties will be very desirable for the people who still want to buy a home. And so that entry level price, I could see that, creeping upwards. That's a safe place too. I could see it not dropping near as much. And there are, as someone just said, Windsor is very hot. There are pockets in London that are still very hot. Multiple offers, things going crazy. Certain segments are still doing very well. I think Windsor's overpriced. I'm bearish. I think there are pockets in London that are overpriced. I'm bearish. For that reason, I'm selling my own properties because I'm bearish. There are lots of people who are bullish. I've been in the game a long time and I've seen these values creep up to points where a lot of these properties aren't great for cash flow. And Windsor is not a super strong economy. Like it's a lot of blue collar. The university's not so great there. It's next to Detroit. Like in Detroit, you can't even keep a house. You buy a $20,000 house in Detroit, you can't even cash flow it because the people will just, the tenant profile will destroy the house if you make it nice. You lose so much in repairs and maintenance and capex. And I think people in Windsor will find the same thing over a longer period of time once the appreciation dies down. I got lots of friends in Windsor who have made bags of money because they bought low and now it's high. But from a cash flow perspective, there aren't a lot of really quality tenants. And the lower quality tenants tend to destroy the properties. So there's a lot of deferred maintenance and deferred capex that comes up when the tenant eventually leaves. And so you lose potentially a whole year of what maybe you look like you're making $1,000 a month in cash flow and you're bragging about it on social media and whatever. And the house is doubled in value or whatever, like something like that, or 10%, 20% appreciation in 6 months. And I hear a lot of those posts, but then the tenant moves out a year from now and you're stuck with a $30,000 renovation because cost of materials is up. There's a labor shortage for good quality contractors. And all of a sudden you're painting floors, repairing a kitchen and some other small stuff that tenants destroyed. And that's costing you 3 years of cash flow. So you just own this property with negative cash flow for 3 years. And if the market's pulling back a bit, we're having a bit more of constriction, maybe you're not getting that appreciation bump anymore either. And you're like, geez, maybe I should just sell this. And then everyone starts thinking like that. Geez, like, why would I buy this property? I can just wait a year and buy it for the same price or maybe less. So people just hold off and they don't buy. And when the demand pulls back from all the speculators, because the speculators are what drive the economy. It's not, especially in the rental market, it's the investors and the speculators that are pushing the prices to all-time highs, right? Like, it's a lot of Asian and Indian money, international foreign capital, people who live here who are now Canadian citizens, but, they made their money elsewhere. And they've got capital they just want to, park from Toronto or from Vancouver or from a large metropolitan. And Windsor seems really affordable. And they just want to park like 300 grand there. When they realize that they're just going to start losing money, all of a sudden that capital dries up in a second. I've seen it happen. In 2020, I watched it happen in London and in many other markets. We saw a 15% pullback in 4 months. Canadian real estate can pull back real quick too. I watched it happen here. And in the 90s, from 1990 to 2001, even in markets like Toronto, we had almost no appreciation. Inflation moved faster than real estate prices. That's a fact. You're better off holding cash than holding real estate through that 10 years, unless you're holding quality cash flowing properties. But from an appreciation perspective, the next 10 years aren't going to look the same as the last 10 years. And the last 10 years, we had a phenomenal bull market. I wished I had been more bullish. I'm always conservative in all of my approaches. So I'm like, I wish I would have levered up. I wish I didn't. I did a ton of equity deals. And if I just raised debt and taken those deals down and just borrowed from all the banks and just, levered up to the tits and it appreciated 100%, I would have made like 500% on my down payment, right? If I'd done that with 100 properties, I'd have $150 million right now, right? Like across those 150 buildings that I have done, right? Instead of taking small wholesale fees and small JV partnerships, I could have structured in a different way, but I was always fearful of a downturn, right? I'm always conservative in my approach. And I think that's an approach you should take in this market now is don't be so bullish that I'll give you an example. There's a Fanshawe College in London, Ontario here in my city, in the east of the city. That college is one of the biggest colleges in Canada. It's great. Houses there used to sell for, right on the street next to the college. There's a couple of streets there. Everyone knows the names of them. They're like the party streets for student rentals. But those houses used to sell for $350,000 for a 5-bedroom, 2-bath kind of house. They rent for $500 a bedroom, you get $2,500 a month. It was a little bit under the 1% rule. It kind of made sense. Students are, they create damage in the units and all that kind of stuff, higher than a normal tenant. So there's some extra wear and tear, and every year you got to handle that. And there's a bit more vacancy and stuff too, potentially. But the business made sense. I had friends who were buying properties there. I had some properties in that market. I sold a bunch of them off, unfortunately, before this happened. But what happened in the last, we'll call it even 6 months, is prices crept from $300,000 to $950,000 for these 5-bedroom houses that are now renting for maybe $3,200 a month. A little bit more in rent. You're getting $600 a bedroom. Let's call it like $3,200, $620 a bedroom. And now your mortgage payments with the interest rates rising at these prices that we were seeing, if they were to stay at the prices that it is now, you'd be cash flow negative $2,000 a month. And people are gobbling these up. It's almost all investors from Brampton putting Indian students in. They're going to Fanshawe. I don't want to generalize, but like probably a third, like having walked the street, probably a third is all foreign Indian money. I don't know why that is. I talked to several people around there. Buddies of mine who have sold 5 and 10 properties off, all Indian buyers, all Brampton and Toronto realtors who are Indian. I don't know why, but that's just because a lot of the students at Fanshawe College are Indian, so maybe that's why. But buying this and dumping like gobs of money into these properties, and they're going to lose their shirts. They're going to be cash flow negative. And then the market's going to realize that cash flow negative properties are not desirable, and the price is going to come down from 900, 950 comps that we were seeing in February at the frothy top to now maybe 650. And like, in the last year, the houses were only 400, last 2-3 years, they're 400,000 or 500,000. So it's still appreciating technically over like a 2-year, 3-year time horizon, but that's a big drop. They're going to lose more than their down payment, and they're going to be cash flow negative. So some of these investors are really in for a world of pain. Don't be that investor if you're watching. Don't be buying those houses that are cash flow negative, right? If you're buying like a solid triplex bringing in $6,000 a month in income for $700,000, that's a good buy. That's different entirely than a student rental. That's, a 5-bedroom student rental or something, right? I don't know why it is, but they feel very comfortable with the newer houses that are within 30 years old that have mostly negative cash flow. That's scary. We don't want to buy negative cash flow properties, especially going into potentially the greatest down market in real estate we've seen in the last decade and a half, maybe even two. Probably it'll be the worst, I think, in the last 2 decades. We'll be a lot like what we had in the 90s here in Canada. I think there'll be a flat period. You can still make a ton of money in real estate. If you know what you're doing, you can use this opportunity to buy properties at 70 cents on the dollar, stuff that's stale. People who have expensive private mortgages that have gone up even more with interest rates rising. They're underwater, they're vacant, they're sitting there, they got a property that's now not selling. They'll start to consider your offer at 70 cents on the dollar. When there's no foreign money coming in, there's no Toronto money coming in, offering them 20% over asking, and it's sitting, then you can really negotiate. That's when the true real estate professionals, that's when they shine. And I'm excited for that because I've watched so many hacks in this business make millions of dollars over the last 4 or 5 years with no good skills. They go in and they just buy at full price and they do nothing, or they hold it and they over renovate and they do a shitty job on the renovation and they overpay for all of it and they still make money. And it's frustrating to watch amateurs and just overall bad investors do really well speculating. The speculating game in real estate right now, I think, is done for the short term. I don't know. That's my 2 cents. Let's do some Q&As because you got a lot of questions here. Let me answer some of these. ADW, how you doing? Eric, how you doing? I haven't checked out that person's stuff. I don't even know who that person is, I don't think. Chad, how you doing? Alex, hey. Nico, best place to live in Canada. Well, that depends. If you're socialist, I think that Ontario is one of the better provinces to live in. Especially if you're a foreigner coming here with some kids, or even if you have some kids here in Ontario, you can get $3,000 a month from the government cash. That's the same as making 50 grand a year, 60 grand a year pre-tax. So you can live here and do nothing and collect money from the government. So there are some good provinces if you're a deadbeat and you just want to chill with your kids and collect it and suck off the system, free healthcare and all the rest. Depends what you want to do. If you're a landlord, as an example, Ontario is not a great place to invest. But Alberta has much better tax laws. It's also ramping up like crazy right now due to the price of oil. That whole industry is going to boom, and that will translate into real estate prices there. Alberta's more conservative, as an example. So they're a bit more flexible on your individual freedoms. I don't know. There isn't necessarily one better province than another. They're all different, and each one appeals to different types of people. I would say Ontario's beautiful. I think BC is probably the most beautiful. Ontario and BC are some of the most beautiful provinces, in my opinion. Some of the prairie provinces are really just flat and dry and boring. There's not a lot going on. Newfoundland was beautiful. It's got some good things going on, but again, you're on an island, on a rock. I've spent time touring all around Canada, and I've been through the Rockies, and it's beautiful too. And Edmonton's beautiful too. And there's so many beautiful places to live in Canada. If you aren't extremely wealthy and you're just an average person, there are so many great places. And Canada's an amazing place. If you make less than 100 grand a year, Canada's a great place to live and raise a family. It's relatively safe. It is quite socialist, but if you don't make a lot of money, if you make like 50 grand a year and your spouse makes 50 grand a year, you don't pay that much tax. You probably get more in value than you pay. Like, we have great police systems here, great social support systems, free money if you have kids. We've got great libraries and roads and amazing healthcare. And they're talking about adding all pharmaceuticals for free as well. So you get drugs for free too, potentially. And eye care and a number of other things all included. So there's a lot of great things. But if you're rich, you can get a better quality healthcare privately. So Canada's not great if you're doing really well and you're successful. And a lot of people who follow my channel are multimillionaires who have invested in real estate over the last 5 years and now have a few $1 million. And Canada's not so great when we talk about that comparison to what you could have elsewhere with your money. So it really depends on who you are, what you are all about as a person, your belief systems, where your income is at. And sometimes it's not all about money too. Like, I know people who pay 50% of their income in tax, and they're like, hey, I make 300 grand a year, I keep 140 of it, the government gets 160 of my income, and I'm cool with that because my family's here and I can't move. And I think that's a limiting belief, that they would say that, like, I can't move, I can't do this. You could find a way to do it. Maybe you could snowbird and live somewhere else 6 months, 7 months, come back to Canada 5 months, pay no tax in Canada if you wanted to, and it could all be paid for just for the tax savings. But people don't want to open their minds up, and so teach their own. I cannot tell you or preach to you what is the right way for you, but open your mind. There's lots of opportunities. And I think from a quality of life perspective, I think snowbirding is the best way to do it, where you're gone from Canada in the winters. But to each their own, right? Everyone's got their own thing, and who am I to throw the rock or the stone, right? So DW says, I watched your live. Sounds like you've been talking to Andrew. I haven't actually talked to Andrew from Nomad Capitalist. I've seen his page. I've followed his stuff. Some people have recommended some of his stuff. And I like what he says. I love his catchphrase, go where you're treated best. It aligns wholeheartedly with how I feel. Yeah, you should do what's best for you and your family. I don't feel this sense of like, I should be a slave to humanity for the good of humanity. No. I'm out for my family. Like, I can help my mom, my dad, my kids, my wife, my brother, my friends, people in my circle. I'm worried about that. I'm not worried about the druggie with a needle in his arm. Okay, a little bit. I pay a little bit of tax so he doesn't die. But like, that's where I draw the line. Like, he needs to have a place to sleep, a shelter to be in where he can get food, but then give him opportunities. Let's take his time and train him and make him give his time to get. Put him into community service programs. Like, there's a lot of things we could do to utilize the quarter of society that currently does nothing. There's struggles with mental illness, is on the streets, minimum wage type people that can't hold down a job. That quarter or third of society, it's actually a large percentage of the Canadian population that's sucking on that system. We could put all that talent, all that labor capital into furthering our society, and that would be an amazing thing. Unfortunately, the progressive socialists, they like to just give handouts with no strings attached. It's not me. Hey, how you doing? Good to see you on. Thank you for the comments. All you guys, appreciate you all. Seema, Bill, William says, evening Mike. Remember that like button. That's right, 22 likes. Let's get 44 likes going. Everyone just smash that like button. Just tap it a little bit. So that person asked, but if interest rates will rise, wouldn't it be better to have fixed rate debt? Yes, but all of the fixed rate debt now has priced in all of these rises. So there's a chance that you get, like right now, rates are low. And so for the next few months, you could end up paying less than you would have paid on your, let's say you get a 2% 5-year variable right now, and the 5-year fixed is say 3.79. That's almost a 2% spread. So for the first 6 months, you'll be paying less on the variable product. It will slowly inch up, whereas the fixed rate, you'll be locked in now. But what I've found is that typically over a 2-year period, you might have a property before you refinance it again. Because again, as we build equity in our properties, we refinance it and buy another rental property. That's the Rosehart model. We take the equity we have in our properties and we redistribute it into better assets to produce more cash flow. We don't want to pay down a rental. That's retarded. You don't want to pay down a house ever. 5 houses at 20% down is the same thing as 1 house fully paid off. You need the same amount of money to buy 5 houses at 20% down as you do 1 house paid off. So if you have 1 house paid off right now, you could refinance it and have 5 rentals. 5 rentals after mortgage payments, if they're bought properly, should cash flow around $500 per property. So you're looking at $2,500 a month in cash flow. A paid off mortgage with the 1 house is looking at like $1,500 a month in positive cash flow. So you're actually way further ahead with these ones than you are with one. So you never want to pay down a debt. Why would you want to lock yourself into a 2 or 3% return? That's horrible. I think all of us have the ability to get at least a 10% return on our capital. And by using leverage, we can often put 20% down on a quality real estate asset with positive cash flow and get a 20 or 30% return on our down payment. Again, because we've used the bank's money at 2%, our average cost of debt on that asset is much lower than the return or ROA, return on asset, that asset is producing. That is how you make money. That is the secret to make money. Leverage is your best friend if you get cheap leverage, cheap debt, and you buy quality assets. Where people go wrong is they get expensive debt to buy assets that depreciate in value. You don't want that. Or they get expensive debt to buy assets that appreciate in value, but they don't have any cash flow to service them, and then they're forced to sell them at a loss. Again, you don't want that. You want to use debt to buy assets that produces cash flow that more than self-services the debt. That's important. That's how you succeed in real estate, in business, in the stock market world, everywhere. Buy quality dividend companies that produce steady, stable dividends that more than pay the cost of the margin debt if you're using debt to buy dividend quality stocks. Again, same thing in businesses. If you're buying a business that's solid cash flow, again, you've got to be pulling equity out of that business to buy another business or buy other real estate. Or the more assets you have and the more buckets, the better. I think especially if it's associated with cheap debt and you have the cash flow from those assets to more than service the debt, then the debt is not really costing you anything. It's making you money. And that's what you want. You want to use other people's money to make you money. That's the secret. Da, 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 da. If a house is valued at $500,000 and somebody buys it for $500,000 over asking, DW says, isn't that person in the hole from the jump if the property is only really valued at $500,000? I don't get it. Let me reread that. So if a house is valued at $500,000, okay, so you're buying a house and someone buys it. Oh, 500,000 over asking. Sorry, I missed the over. Yeah, I mean, if a house is valued at 500,000 and someone pays $500,000 over, then they're losing. What happens though is the reason you see over asking is because a house will be worth $500,000 and they'll list it for $299,000 and then it will sell for $550,000, setting a new comp. And so the appraiser will say, hey, it's worth $550,000 because that's what people are willing to pay in a market multiple offer situation. And if you get a few of those comparables on the same street or the same area, you now have set the value. If that happens 2 or 3 times in a row, that is the value of the house. What other houses are selling for in the area becomes the value. And so you can actually set the value of a house. If I could buy 100 houses in a small city, I could set the price of houses. As long as I can find someone to buy them, I would control all the comparable assets. Okay, so in that example, you said, yeah, I mean, if it's valued at 500,000, no one's going to pay over 500,000 for it. Now, if someone listed a house that's worth 500 for 399, it might go $100,000 over asking, in which case it would go for the value of the property. But yeah, I mean, people do overpay sometimes a little. It does happen, especially in an appreciating market. They continue to set new comps as people outbid each other for the price of the house. That's a simple supply and demand issue. That is what it is. But yeah, I mean, in theory, if someone's buying something for under market value, unless, of course, the property is extremely derelict in nature and needs some renovations or improvements, and maybe it's worth 500,000 now, but you could put 100,000 into it, and now it's worth 800,000. In which case, that person is seeing the future value or the after renovated value, and they're saying, hey, the ARV of this property is 800, and I can buy it for 500 and put 100 into it, and I can unlock 200,000 equity. In which case, they might pay 600 for that property. It's only worth 500 because they know they can get the renovation done for 100 and still make $100,000 profit. So it's not always about the value now as is, although that's important. I think you should always be considering the value as is, and you don't want to overpay at outset because what if something happens during your renovations, costs balloon, whatever. It's always better to buy under market value on the buy, but I understand why people might overpay above as is value because they're looking at an after renovated value and they have a way to deliver that renovation at a lower cost than someone else. Maybe they can do some of the work themselves. Maybe they have a connection to someone in their family that can renovate, and they can do a $200,000 renovation for $100,000. In which case, that property might be more valuable to them than to someone else. That's just how it is. Yeah, so another point I wanted to make to the previous question about fixed rate debt. Variable rate debt is better because one, you can refinance or sell at any time. And two is because over the period of time that you probably have that property before your next refinance, more than likely, or sale, more than likely, you're going to have a lower, over the last 20 years, every single time you chose variable, you'd win. Fixed rate debt over the last 20 years has never won out. Never. It's lost every single time. Because with the variable, unless you have a huge amount of hikes that happen immediately and stay high for a long period of time, the variable product wins out because you have a lower mortgage payment at the start, which I think that's the most important time to have cash flow to invest into the asset. So I think variable is still better, but you don't have the huge break. Like a fixed rate mortgage, if you sell it or you refinance it at any time, if you're on a 5% down product, you renovate it, you want to go refinance it, you pay a huge fee to break out of a fixed rate product, a 5-year fixed, a 3-year fixed, 2-year fixed. There's a huge breakout fee. On a variable rate mortgage, there's just a couple of months interest payment. There's not a huge breakout fee. So that's very important when you're considering your options. But yeah, I mean, fixed can make a lot of sense. I think fixed rate mortgages actually, in this climate right now, do make a lot of sense. More so than they ever did before. In fact, I think variable probably would lose out. I think it's probably better to do a fixed rate mortgage if you're not planning to refinance or sell anytime soon. So that'd be my general advice, would go fixed. If you're not planning to refinance or sell, go fixed. Don't even think about variable. If you're going to refinance it though, you're doing a big renovation on it, you're buying something with a value add, go variable and then go fixed after you're finished with the renovation when you get that large value. Predictions on East London market near Kiwanis. Undervalued? Question mark. I don't know. I'd have to take a look. It's hard to say in a specific area. I don't know. It's an okay area. It's like a C+, B-. Potentially. Baker says, do you think the feds will implement a capital gains tax on one's primary residence in Canada? It's on the table. I don't know. They be coming at the throats of all the people who own properties. If you had, and there are a lot of taxpayers and a lot of voters. If you had one primary residence with a suite rental, would you cash out and leave or stay in CDA? What CDA is? What does that stand for? I don't know. But okay, so the first part of that question, I answered that already. I think they could come with the primary residence with a cap on it maybe. Like if you make more than $250,000 in your primary residence, they might come after that, which would be only targeting the rich or the people who have properties in Toronto or Vancouver. I don't know. There's a huge voter base. Like probably 40% of people own their own home. I don't know what the exact stat is, but almost the majority own their own home. So they'd be coming at a base that what they're going to instead, for sure, is capital gains inclusion rates are currently 50%. They're going to increase them to 75%. That's happening next year. Um, that's going to happen. They are going to raise the capital gains inclusion tax rate from 50% to 75% in Canada. That's coming. It will probably apply also to stocks and businesses and other things too. So that'll be a great source of revenue. They need to raise revenue because they created thankfully, inflation actually pumped the value of all the assets. So now they can tax those assets that they artificially pumped in value and take a percentage of. You have the same buying power. They take a percentage of what you have. You have $100, it becomes worth $200 after inflation. They take, $30 of it, and now you have $170. So your $100 used to buy you $100 in stuff. Now your $170 can't even buy you $200 in stuff. So you actually have less than you had before because after tax, they take you for a ride. So inflation is great for the government. They'll raise a lot of money. They'll be able to pay on some debt, hopefully. Probably not because they're a liberal government. They'll just find a way to spend it and waste it. But overall, they need to fill the coffers full of tax money. So they're going to come for blood from the entrepreneurs and the business owners and the people who have assets because they're going to have to service all that debt, all that money they printed. Guess what? They had to pay interest on all that debt too. And all the interest rates are going up. And that means interest rates between countries too as prime rises. So the cost of servicing said debt and all the money they just printed is going to go up too. And so the affordability of the government then drops too. So taxes have to rise, especially in countries like Canada. Still long-term bullish. I think that, if Trudeau wasn't an idiot, we could utilize a lot of the natural resources we have in a sustainable way. We could extract oil and we could extract, some of the minerals and things that we have here in Canada and begin to export them. If we don't, some other country will to fill the need that exists, to satiate demand. But they're going to do it in a way that's way worse for the environment than we will. We have much better environmental practices. We can produce oil here in a more efficient way than they can in, say, some second world country, right? So it's net better for the planet if we produce it here, where we have more stringent filters on our coal plants and things like that. So there's just so many better things here. And anyway, I don't want to fight with Greenpeace here because I know those guys just don't want to produce any oil at all. But they say that, and then they get into their truck and they drive across town to talk about Greenpeace. I mean, it's just hypocritical. Hypocrisy. What is a good resource to track these interest rate increases? Go to Google. You just check on Google. There's some analysts you can follow too that track this. You could just listen for Fed announcements. It'll be on all the news outlets too. Which areas can we target for prices that are $300,000 properties? So in London, you're not going to buy it in good areas. 300,000 does not get you much in a good area anymore in London. Probably in London, you'd be like 500,000. But the 500,000 in London is the same to me as 350,000 in Windsor. It's the same thing to me. They're both entry-level properties. People make more in London. It's a better city, et cetera, and so forth. I feel the same thing with entry-level houses in Toronto. I still think there's great value there, though I do believe in people moving towards remote work and there being less value being in a major metropolitan. A lot of people are still extroverts. I'm not. I'm introverted. I'm cool to not see anyone. But I get that people need that social interaction. And because the metaverse isn't built out yet, and I think we're still 20, 30 years from where it is needing to be before it's as robust as an inhuman experience. For that reason, I think that in the short to medium term, and again, people just like to be close to each other too, right? They have family and whatnot. And Toronto's such a big place. It attracts so many immigrants and things that just don't want to live in, say, Windsor, 3 hours away, right? So there's, I don't know. Entry-level houses, I think you'll do really well. Commercial real estate, I'm still very bearish on commercial real estate. I've been bearish on commercial real estate for some time now with rising interest rates and lower demand for office space as people learn to work from home and we continue to advance technology to the point where we don't need as much office space to run a business. There's so much available inventory here in London. I'm bearish. I think rates will continue to fall. Therefore, cap rates will fall. Income will fall, and then cap rates will fall as a result of the fear and the lack of cash flow. So I could see commercial real estate being pivoted towards residential. We have a real residential shortage here in southwestern Ontario. There aren't enough housing units. The government is also not helping things. They need to relieve the red tape. It takes I have a duplex conversion that I've been doing for over a year with a permit, and it's like revision after revision, deficiency after deficiency. They don't make it easy for you to add units. So there's that, right? If they made it easier for people with capital, landlords, to add units, there'd be more units in the city to rent out, and we wouldn't have such a shortage. But they make it hard to build. They make it hard to add units, and they make it very complex and a long, expensive process. And so that drives rent prices up. It is what it is. That's just a fact. I wish the government would actually be pro. And then they do stupid things like just banning foreign buyers. That doesn't help. Instead, you should open up foreign buyers and say, hey, we're going to create an incentive that if foreign buyers build new inventory, we're going to give them money or something. Or even if locals do it, we're going to give you money. We're going to reduce the red tape. We're going to incentivize what we want. That's how you get results that you're looking for. You don't ban things. You incentivize them, and the capital will follow. Instead, we're going to have, there'll be a lack of affordable inventory, but at the same time, there'll be, a bunch of pent-up demand. When that 2 years finishes, all those foreigners will begin to buy. Or they'll just find workarounds. They'll have a cousin that lives here that can buy it, who will open a corp and buy it there, and then issue shares to their long-lost cousin in mainland China or something, right? Like, or in India or whatever. There's going to be workarounds anyway. It's more lip service to get votes, I think. Da, 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 da. DW says, can't even buy a regular house for a family in this market. Home buyers took over my city and massively overpaying for properties. Yeah, I mean, it's a lot of foreigners with capital. And there are even a lot of foreigners who have now become citizens, who are Canadian citizens, but have been here for 5 years, who came here with millions and are invested in this market and continue to keep the prices propped up. So there is some stickiness to the prices. A lot of Canadians won't sell, even if prices drop. They're on fixed rate mortgages. They'll continue to hold their properties. So the residential single family market likely won't see huge drops. It'll see a flattening effect. We're not seeing a huge jump anymore. It'll be flat for a while, which is actually healthy and good. I don't know how people flip in this market. Yeah, I mean, it's true, Chung. The thing is, in the previous 6 months, people were buying stuff, doing nothing to it, and making 40% because the market just appreciated so much here in Ontario. So anyone could have flipped and made money. It's going to be a harder market to flip in. You have to negotiate better deals. Tyler says, Mike, I'm 23 and I just bought my first rental in Aurelia. Question is, I'm ready for another. Should I wait around or branch out to one of the coasts? Would love your opinion. It depends, Tyler. You've got a rental property, which is good. You're into the market, so if things do appreciate, you're going to get some of that appreciation. If you can buy stuff that has quality, at least B tenant quality people living in it, and is positive cash flow, run your numbers at 5-6% interest. If your property can cash flow with a 6% mortgage, you're in good shape. You're gonna be all good. Rates are not going to creep that high, right? We're going to see, maybe 10 hikes. I see that 2.5% potentially coming, but we're not going to go past 5 and 6%. So there's, and then when things do cool down from the interest rate perspective, the real estate market will heat up, and so you'll be in a good position. But yeah, I think that we could potentially see a flattening for a long period of time, in which case, like, if you buy a property now versus 6 months from now, there'll be almost no difference. So there's no like need or urgency to buy something right now. Take your time, go through 100 listings, see 50 properties, offer on many, and the right ones that were willing to come down to a price that makes sense for you at a good enough discount, continue to buy. Go ahead and find those opportunities and buy those, but don't feel the need to rush into something. Make sure you're doing your numbers and doing your homework. Do I think they got serious about fighting inflation, Mark says, or just hawkish talk? It's hard to say. Just the talk enough can force inflation away a little bit, can kind of keep things at bay. Fear, is enough for people to want to, the fear of interest rates rising a ton is enough for people to want to hold on to their cash, right? Because it will force inflation down, right? I don't know. If I had a crystal ball, I'd be betting it all on it, right? I don't know just as much as the next guy. It's likely we'll see many more rate hikes. I think the Fed in the US today was very dovish. A lot of what they were talking about seemed very dovish, kind of letting things sort of float up, rates float up. I don't know. Will they be hawkish and kind of keep rates in line with, under 4% prime in the next year? Probably. It's also possible we could have 6%. So run your numbers at the worst case scenarios, I think, and keep cash. Stay away from leverage at this point in time. I have no idea what the M5 project in Mississauga is, so I can't even comment. I don't have enough information on it to make a informed decision one way or the other. Cool. Got through all the questions. It's almost 8 o'clock. Gotta put my kids to bed. Thank you everyone so much for watching the stream tonight and every week from 7 to 8 p.m. Eastern time, Standard Time. If you're watching this now, smash the like button. Hit that. Just tap it. Share it on social media. Share it with a friend. If people watch this stuff, it helps the engagement. I charge nothing. There's no ads. So it makes me no money. It's just trying to do good for the world and for the community. And so that's why I do this. Continue to do this every year for the last, it's been 4 years now. 4 years? Yeah, I did it a year after I quit my job. So yeah, 5 years I've quit my job and retired for 5 years now. Well over 5 years. Yeah, so the secret to unlocking wealth through you guys. And I forgot to plug, if you want to find me on social media, go find Mike Rosehart on Facebook and at Mike Rosehart on Instagram. Those are the places where I do stories often, so you can check those out if you want to connect with me. Yeah, hopefully I'll see you guys in the comments, and if you're watching the replay on this, give it a thumbs up and just let it play for me. Give it some watch time. It helps people to find it. Since I don't let ads run, YouTube makes no money off promoting my video, so my videos don't get promoted. I also don't do any SEO optimization at all. I don't even put keywords in my videos, which is something I should do. I should get a personal assistant and then have them do that. Anyway, thank you so much for watching, everyone. The secret to unlocking a wealthier you, 3 levers in your control of your financial future. Spend less, earn more, and maximize returns on the difference. In that order when you're first getting started, in the inverse order once you've built up some asset base. Thanks, everyone, and we'll see you next week.